Welcome back, everyone. Hope you've had a good last few days. As you know, the whole point of this channel is to get you a little bit more acquainted with anything finance related, money related, and make you a better money manager. So today, what we're going to be talking about is a credit score. And before we even get started, don't forget to hit that like button. We've got a nice new sign up here. Subscribe, you better do it. And then we will be talking about your credit scores. So you might have heard of a credit score before, and you might have heard of something called a FICO score. And those are actually the same thing. So a FICO score actually stands for Fair Isaac Corporation, and it was started by two different guys. One of them had the last name Fair, one of them had the last name Isaac, so they created a corporation. Fair Isaac Corporation stands for FICO. The credit score is basically a way for lenders to determine how likely you are to repay your loan, and it comes in a scale from 300 to 850. If you're 850, it's pretty much a near perfect credit score. If you're down at 300 or even 650 and below, you're pretty much like not super trustworthy. So we're basically going to talk about what goes into a credit score. If you have a low credit score, don't worry. We'll talk about different ways you can actually increase that. And then by the end of this video, you'll basically know what a credit score is, how the different things that you do on a day-to-day basis and a month-to-month basis actually affect that score, and what the actual impact is on you in the long run in terms of your ability to actually get money if you need to buy a house, get a car loan, do student loans, anything like that where you might actually need a little bit more money than you have in a bank account. So the main idea behind a credit card specifically is that you might not have that money today to actually be spending on something. So let's say you go to the grocery store, you spend $100 and you just don't have $100 in your bank account right now, but you're getting paid next week, so then next week you definitely will have $100. So basically what a credit card allows you to do, or what credit allows you to do, is make a purchase without having the money to pay it back today, knowing that you'll pay it off in the future. So even if you're young and you're not planning to make any big purchases in the near future, it is still important to get your credit score in order and to start building credit so that when you are ready to make those purchases, you're not held back and someone can actually see how trustworthy you are and be willing to lend you the money that you actually need to make that purchase in time, rather than you being a 20-year-old, waiting till you're 30 to start building up your credit, and you want to buy a house or you want to buy a car, and then someone says, sorry, I'm not going to lend you money because you have no credit history. You don't want to be in that position. So basically, let's just walk you through what you need to do to build your credit score and maintain a good, trustworthy persona for the credit companies and the banks that are giving you the money. So there's a few benefits right off the bat of having a good credit score. And so let's say there's two different people. Let's say there's Sharon, and then let's say there is Tom. And Sharon has a really high credit score, and Tom has a really bad credit score. He never pays back his credit card payments, and he's basically delinquent on a lot of things. So Tom doesn't have a good credit score, and Sharon has a good credit score. And they both want to get $10,000 from the bank to purchase a car, just as an example. So basically, because Tom has a poor credit score, he actually either one, might not even be able to get money from a credit card company or a car loan company, but at the other hand, he might actually have to pay a much higher interest rate than Sharon would have to. So Sharon, because she has a really high credit score, she's going to basically have the trust of a lender to say, okay, Sharon's actually, if we give her $10,000, the likelihood of her paying it back is very high, whereas for Tom, the likelihood of him paying it back is relatively low. So it's riskier to lend to Tom than it would be to Sharon. And so in this case, when you actually get a higher interest rate on your loan, it basically means that you have to actually pay more to actually take $10,000 from the lender. So in the case of Tom, let's say his interest rate is 10% and Sharon's is only 3%. That difference is relatively significant in the sense that you're actually going to be saving money by having a higher credit score than if you have a low credit score as well. So that's one of the benefits. The other is if you're actually getting credit cards, you might not actually qualify for certain credit cards that have sign-up bonuses or maybe other perks because you have a low credit score. So by having a high credit score, you can actually get better credit cards, which means that you can get better bonuses, better perks, things like that. That's another benefit. And just in general, it means that you can actually get money lent to you. So if you want to buy a house and you have a really low credit score, you might not actually be able to get a house. Whereas if you do have a decent credit score, you can actually get a loan and actually go and purchase a house if that's one of the goals that you might have. And now, as you're driving down the road, you might have seen some of those car dealerships that say, no credit, no problem. And those are kind of like a a different story, so we won't go into that today. But basically, if you do have a decent credit score, typically it's like above 720 or higher, or even if you have a 650 or higher, you can get a loan from people. If you're underneath that, just either means one, you're gonna have a really high interest rate, or you might not even be able to get money at all. So now let's dive into what actually goes into the factors of your credit score. If you don't have a credit score, if you have a bad credit score, if you don't know what it is, don't worry. This video is basically kind of walk you through what the different steps are to either one, get a credit score, or two, kind of start being on the road to recovery to increase your credit score to become more of a trustworthy lender of money. So the first factor that we need to take into account is actually on-time payments. So if you do have credit cards or you have loans right now, you know that every single month you get a statement that says how much you owe. And there's some sort of minimum payment associated with that. But basically you have a statement balance and there's a due date on that that says, by this date, you have to pay this statement balance. So what a lender wants to see is that you're actually paying your bills on time. And so this is the number one factor in terms of what actually goes into your score. It factors 35% of your score is based off of your on-time payments. So let's say you have a credit card right now and you've had it for, let's say 100 months. Or let's just say 120 months, which is 10 years. Basically, if you've only missed one payment, your likelihood to pay back or your percentage of on-time payments is way higher than, let's say you just opened a credit card this year, 6 months ago, and you've already missed one of the payments. So 5 out of 6 is a way lower percentage than 119 out of 120. So that factor, basically you wanna have your on-time payments be about 99.7% or higher to actually determine if you're in the high tier for getting a good credit score or not. So the biggest way that you can positively impact your credit score right here is to just pay on time. So when you get a statement, pay it off on time. Don't spend more than you actually have to be able to pay it back, because then that's gonna make you a delinquent on your payment, and then your on-time payments is gonna be negatively affected. Pay off the balance on time, and that's gonna be the number one thing that actually factors into your credit score. And the one other thing, although I don't necessarily recommend this, if you are in this situation, the only thing technically that you have to pay back to be able to positively factor into your credit score is the minimum payment. So although it's recommended that you always pay off your balance in full, if there are situations where you can't pay it off in full, at least pay off the minimum payment so that that actually doesn't affect your credit score. So either one, pay off in full, or pay off your minimum payment, and that will positively affect your credit score, increase your on-time payments. So then as you are building up credit over time, as you have, let's say, like 10 years of credit history, if you miss one payment, and that's the first payment you've missed, it's gonna have a much smaller effect on your credit score than if you're just starting out and you miss a bunch of payments right in a row. But in general, don't panic if you have missed payments. It just means that in the future, you might have to be a little bit more careful to make sure that you're making on-time payments of at least the minimum payment, but more recommended, the whole statement balance. So the second factor that goes into your credit score, and this is actually 30% of your credit score, is credit usage. So basically what that means is when you have a credit card, as an example, that credit card company will give you a certain limit that you can actually spend per month, or that you can have taken out on the credit card at any one time. And so what a credit card company wants to see, or what the FICO score or what the credit score wants to see, is that even though you might have, let's say, a $10,000 limit on your credit card, every single month they don't want to see you going up to $10,000. Basically what that means is because you're going up to your limit, you could be more risky rather than someone that's only utilizing, let's say, $1,000 of their $10,000 limit every single month. So one way to positively impact your score on this is just to have multiple different lines of credit that have a credit limit that's relatively high compared to what you're actually spending every month. Now that doesn't mean just because you have a credit limit of $10,000 or $20,000, it does not mean that that means you can go spend more. It just means that it's able to decrease the amount of usage that you're actually putting onto your credit every single month. So the range you actually want to look for here in terms of like a really good usage would be 10 to 15%. So again, using that $10,000, you want to basically, if you have $10,000 of credit usage per month, you basically want to be spending about $1,000 to $1,500 every single month. The higher you go into that, the more it can actually affect your credit score and bring it down a little bit. So that's the second way, and that is the credit usage. And basically, you just want to make sure that if you do have a certain limit on your credit, you're not going up to that limit every month, and you're keeping it somewhere within that 10 to 15% range. And the one recommendation here that you can do is you can actually ask for higher credit limits. So if you've had a credit card for a really long time and you've never actually asked for a limit, or you've never actually seen this, what you can do is you actually log into your credit card statement, or just log on online, and you'll see something typically when you log in that'll say credit limit. and it might say $5,000. And if you've actually never changed that, it's really easy online. You can just go in, typically you can request online to increase your credit limit. It'll ask you for your annual income, see if that's changed. It'll kind of factor in what you're making every single month and what you're actually already paying every single month, and it'll see if it can increase your credit score. So if you haven't ever done that, it's really easy. Go on there, it'll take a couple minutes, and you might actually automatically just be able to boost your credit score by a few points just by increasing that limit right off the bat. So I actually just did that today. One of my credit cards increased it from $2,000 to $6,000. So basically what that means is even though I'm not gonna go spend that $4,000 difference, I now have a higher credit limit, and every month when I'm paying the same amount on my credit card, the credit utilization or the credit usage percentage will actually be less because my limit has now been increased. So that's one little tip you can do right now. And actually comment below if you do go onto your credit card and you increase your limit, and let me know if you were successful in increasing your credit card limit. Give me that comment, and don't forget to subscribe. The third one is actually called the credit length. And basically what this means is how long have lenders been giving you a credit limit or putting you on credit so that you actually have money to take in when you actually need it. So if you're young, let's say you're 20, you're just getting started out, you're gonna have a really low credit limit just naturally because you've not had a credit card for that long or you've not had a loan for that long. So the goal is that basically over time, someone wants to see that you're not just getting a credit card, canceling it, getting a credit card, canceling it, getting a credit card, canceling it. They want to see that you have a long history of steady and consistent credit among different issuers. So for example, let's say you start when you're 20, you have one credit card you open up, and then by the time you're 30, you still have that credit card, and that's the only line of credit that you have. That basically means that your average length of credit is 10 years. But let's say then you add in a second credit card when you hit 30, so you now have 2 credit cards. Well, now actually your average length is only going to be 5 years because you have 10 years total of credit, but you have 2 different credit cards, so that would be 5 years. So basically the average or the recommended length is 9 years. This doesn't factor as much into your score as the other 2 that we've talked about do, but it's still important. So basically just try and, if you have a credit card, try and find one that has no annual fee, and basically have that credit card, open it up, pay it off, make sure there's no balance on it, and then you could basically just put it in a safe. But basically having a credit card for a longer period of time will increase that average length, and it'll actually increase your credit score as well. So basically with that, open up a couple different credit cards, keep them safe, make sure there's no annual payment on them, make sure your payment's actually paid off, and that'll actually increase your credit card. And don't actually keep opening up and closing credit cards, because what that'll do is it'll just drastically reduce your average length and will actually negatively impact your credit score as well. So the fourth factor, and this only factors in about 10% of your credit score, is actually the total number of credit lines that you have. And so basically what someone wants to see, in that previous example, we used the example of only having one credit card from the time you're 20 to the time you're 30. But what a lender wants to see is that you actually have a wider range of credit. So it doesn't have to be that you have 10 credit cards, but it could be, hey, do you have an auto loan? Do you have student loans? Do you have a home loan? Do you have a couple credit cards? They kind of want to see a diverse group of this, and also just make sure that you don't have one specific card or one specific credit line that you're relying on. So the recommended number is actually somewhere around 10. It could be anywhere from 5 to 10 depending on who you ask. Basically, they just want to see that a couple different lenders are willing to lend you money, and willing to actually trust you to pay back the money that you've actually taken out of them, taken out of your credit limit. And the fifth one is actually the total number of inquiries. So sometimes, let's say you are applying for a credit card, you're applying for a student loan, car loan, whatever it might be, you have to put your social security number in, you have to put your address in, and basically what they do is they run an inquiry on you. So they're kind of running a credit check on you to see, again, how likely you are to actually repay that loan and how much they should be lending you based off of income, employment status, where you live, cost of living, and also like how much you might be spending per month on your credit cards already. So that's kind of like one way, is like just the number of what they call hard inquiries, and you actually want to make sure that the number of inquiries you have is actually reduced. So if you're going out and, like, let's say every month applying for new credit cards, they're gonna have to do hard inquiries on you a lot every single month, and the more you actually have can actually show that you're less trustworthy, because it means that you're asking for more credit very consistently. So the recommendation is not to consistently be asking for new credit and doing these hard inquiries. Kind of keep it steady, so maybe like 1 or 2 per year. And these only stay on your account for 2 years, and actually after 1 year it stops factoring into your credit score. So again, this is like lower in terms of actually its impact on your credit score, but the idea is don't keep going out and asking for new credit if you don't have to. And sometimes too, like if you're going online and you just want to view your credit score, there's something called soft inquiries, which actually don't have any impact on your credit score. And that would more just be where, like if you're using mint.com, which is something that I use, it'll give me a credit report every single month and show me what my credit is. That's not doing a hard credit report or hard credit inquiry. It's basically just doing what's called a soft inquiry, where it's just basically checking my score and it's not doing a deep analysis into that as well. So those are the 5 factors that go into your credit score. I hope you got a little bit more information on what it actually takes to increase your credit score, maintain a good credit score, and what credit actually even is. The whole idea is that you want to be seen as a trustworthy lender of someone's money. So whether it's a bank or whether it's a credit card issuer, they want to be able to see that you're willing and able to actually pay back their money, and that over time you've built up on-time payments and you haven't taken out a ton of credit, or you're not using up all the credit that you're actually given. Put in the comments what you think about your credit score. You don't have to actually tell me your exact credit score. I'm not interested in that. But basically tell me if you went onto your credit card company and you were able to get a credit limit increase, or if there's any other questions you have about increasing your credit score and maintaining like a high trustworthy persona for these credit companies and the banks that you might be lending money from. We'll see you next time, and thanks so much for sticking around to Quinn Talks Money.